Today, rates higher for longer, says the Fed, but who are you going to believe? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, US stocks snapped a two-day rally after the Federal Reserve Chair Jerome Powell reiterated his hawkish stance. And he also signalled the central bank is getting close to reaching the end of the tightening cycle that's pushed rates from near zero to 4.5% since March. In fact, the Federal Reserve raised interest rates by 0.5% on Wednesday and lifted its forecast for rates to peak at 5.1% and to remain at that level through 2023. That was well above the 4.6% forecast in September and poured cold water, somewhat, on Wall Street expectations for a rate cut in the second half of next year.
Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a half percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year, a half percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We are taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals.
During the press conference, the tone was pretty clear. The Fed is going to feel its way ahead with more but possibly smaller rate rises through 2023.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
And Powell dissected the inflation problem into three groups: goods inflation, which he said was easing; housing-related inflation, which is rising; and the wages feedback loop, which is still to play out.
Hi, Victoria Guida with Politico. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily because of wage growth, that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought. Right, so we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump-off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy's having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector, clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the largest, the 55% of the index, which is the non-housing services sector. And, that's where you need to see. We believe you need to see a better balancing of supply and demand in the labor market, so that you have. It's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running well above what would be consistent with 2% inflation.
And he also said that there was no consideration of rate cuts at the current meeting or indeed in the immediate future, which actually puts the Fed at odds with the market.
Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
And the Fed also said the path to avoid a recession is very, very narrow.
I wondered if you could comment a bit more about yesterday's inflation report. I mean, it showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting inflation under control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year, and this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year, so that should help. And the big piece, again, is core services ex housing, which is very important, and we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index, and it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies in getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there, and it boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's, we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this, to the extent we need to keep rates higher and keep them there for longer and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not. And if we do, whether it's going to be a deep one or not. It's not knowable. And certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of so I would put it this way, of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Ryan. Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control, and I believe we will. We're certainly highly committed to do that.
And the Fed's also continuing to project a soft landing for the economy, though, although there weren't that many who share their optimism. Once again, it's hard to believe that the Fed is capable of pulling off such a delicate landing of the economy onto a gradual glide path towards somewhat lower growth, only mildly higher unemployment, and on-target inflation, Jeffries said in the note. Treasury yields delivered a lackluster move on the news, with the 2-year, which is sensitive to the Fed's rate hikes, retreating from its session high. And Treasury's whipsawed with the policy-sensitive 2-year yield surging initially after the Fed's decision, only to almost entirely ease that jump later in the day. The dollar dropped for a second session. Powell indicated the Fed intends to keep at its battle with inflation, as the official projected rates would end next year at 5.1%, but his assertion that the cycle would be near an end was enough to ease the worst of the stock declines on Wednesday. The Fed also projects economic growth will slow next year, with inflation remaining well above its 2% target. Powell was crystal clear that the Fed is basically indifferent to intermeeting moves in financial conditions, but that they control those conditions over time, said Gerald McDowell of 22V Research. The most encouraging of Powell's comments is the acknowledgement of how core inflation is coming down more than expected, as evidenced by new rental leases coming at levels significantly below data being used to calculate core CPI, said Bryce Doty, Senior Vice President at CIT Investment Associates. This is a big deal given that housing is the largest component of core CPI. Therefore, we wouldn't be surprised if Powell uses this as a primary reason for halting rate increases at their May meeting. Bond investors just don't seem to buy, though, what the Federal Reserve is selling, that monetary policy rates will keep moving higher and stay there for an extended period of time. Other bonds saw yields down on the day after Powell's press conference. Reaction likely reflects some signals in the Fed's forecast that point to a steep downturn in growth, which may have bolstered speculation that the Fed will still wind up cutting rates next year to get the economy going again. Officials cut their 2023 growth forecast, for example, and see an expansion of just 0.5% and increase their forecast for the unemployment rate. The median estimate for the Fed's policy rate in 2024 is now around 4.1%. The dot plot revisions and downgrades for growth and employment are as close to a recession call from the Fed as I can ever recall, said George Goncalves, head of US macro strategy at MUFG Securities Americas. This is a Fed that wants to make sure the inflation job is done. Swaps traders expect the Fed to continue easing up on the pace of its rate hikes, as it did on Wednesday, when it made the widely anticipated decision to raise rates by just 0.5 percentage point after 4 straight 3/4 point moves. But it's still sitting at 4.25 to 4.5%, which is higher than it's been for a long, long time. And in its statement, the Fed said it anticipated further increases to make policy tight enough to pull inflation back down towards its 2% target. Powell underscored that message before reporters as well. When asked about the rate cuts being priced into the market, Powell said in a response to a question that officials at the Fed are not even pondering yet the idea of easing ahead. Our focus right now is really on moving our policy stance to one that is restrictive enough to ensure a return of inflation to our 2% goal over time, Powell said. It's not on rate cuts. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2%. So after all that, the Dow closed lower on Wednesday, but it did swing wildly between gains and losses as the Federal Reserve moved to slower paces of rate hikes, but also seeing rates to peak at higher levels than previously anticipated. The Dow Jones Industrial Average fell 0.42%, the Nasdaq slipped 0.76%, and the S&P 500 fell 0.61%. Financials, mostly banks, were the worst hit as the Fed's hawkish stance renewed fears about the central bank over-tightening monetary policy and pushing the economy into recession. PNC Financial Services Group, Synchrony Financial, and Signature Bank were all down about 3%. Technology stocks fell about 1% as big tech traded mixed, with Apple and Alphabet ending the day lower, while Microsoft and Meta were actually in the green. Healthcare was the only sector to end the day in the green, led by another surge in Moderna, as investors continue to cheer the drug maker's positive news on its skin cancer drug from a day earlier. In other news, Delta Airlines cut the bulk of its gains despite forecasting a jump in earnings next year, underpinned by strong travel demand that is expected to continue into 2023. And following the Fed, of course, the European Central Bank will announce its rate decision on Thursday, and markets will also contend with decisions from the Bank of England and monetary authorities in Mexico, Norway, the Philippines, Switzerland, and Taiwan. So in central bank land, the battle for inflation and higher rates to address it is the main tenet. But it does seem that the markets and some of those market watchers do remain unconvinced and still think that a reversal is coming soon. But if you listen to what the Fed said, don't necessarily think the markets have it right. And if that's the case, stocks will continue to slide. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.